Hey, what's up, guys? It is Tuesday, August 12th. Big rally today. Big rally. S&P made a new high. I'm not sure if the NASDAQ made a new high. It might have. It was up a lot. Dow was up. But Dow still has yet to make its new all-time high. That's going to happen. I don't pay a lot of attention to these nominal price levels. I mean, I just look, I stay focused on my framework, which is the fiscal flows. And as long as that's giving me a positive signal in terms of, the monetary condition of the economy, then it's just a matter of time before the market keeps hitting new highs. If that fiscal condition, if that monetary condition, and again, when I say monetary, I don't talk about, I'm not referring to like the stupid, like misinformed monetarists who are, tunnel vision focused on the freaking Fed and interest rates. That's not what I'm talking about. When I talk about monetary condition, I never use the term monetarism, only if I use it to make fun or bash the monetarists who they're mentally retarded. That's it. When I talk about my terminology is the monetary condition, the flows. And so as long as that's giving me a positive signal, as long as I see these transfers rising, steady or rising, then I'm not worried about where the market's headed or where risk assets are headed. It's getting support from a very positive monetary condition. Simple. I try to make things simple here. I don't think, at least not for me. I know some of you guys, you like sitting there in front of your screen all day long, maybe, trading in and out. I've spoken a lot about that. I think that's really a fixation with like, you want a dopamine rush. You want an adrenaline rush. It's kind of like people who like to gamble. I'd rather go fishing, which I have to say, just on a side note, I've been bitten by the bug, the fishing bug. Not that I've been fishing my whole life since I was a kid. So it's not like a new pastime for me. But living down here in Florida, I've been down here for a year now, and I wasn't really doing much. I haven't really made too many trips to the beach because I've been working around the house, or I've been going out to the range shooting my guns or whatever. But the last couple of times I went fishing, I got bitten by the bug. I'm going to buy a new rod because right now I'm using some really light tackle, a 6-foot, very light rod, spinning rod. I'm going to get maybe a 9 or 10 footer so I can cast out farther. Anyway, I digress. I'm getting off track. So I said this was going to be a very positive week because of the monetary condition. Fiscal flows were going to be strong. Yesterday, by the way, I did a video. I said I was kind of surprised by the selling that happened yesterday. And in the daily treasury statement today, I saw that there was a 13.3 billion net drain yesterday. So for me, that explains the reason why the market was a little soft. You drained out, the system got drained out by 13.3 billion. That's not massive, but it's not small for one day either. I mean, it's not like one of these big tax drain days, but nonetheless, to me, that explains why we had that softness in the market yesterday. So tomorrow's the Social Security payment, and of course, Friday's the big kahuna. That's the quarterly interest payment. And I've been saying, the market typically peaks in these cycles right after you get these quarterly interest payments, because these are points in the fiscal year when you see the strongest impulse of flows, and then they taper off. Okay, you get that, you got your normal level of flows, which is like, we're running between 600 to 700 billion a month. And then you'll get 1 month every quarter like February, May, August, November, when you get these quarterly interest payments, where it'll go to like 800 something billion. So it's huge, man, in a month. The other day I was talking about how in 1933, the whole entire GDP of the United States was 57 billion. Now we're doing, in these quarterly fiscal flow peaks, in these quarterly interest payment, distributions, 800 billion in a month. It's incredible, man. I keep telling you guys, like, you can't, until this scenario, until this environment changes, and it might, because I've been pointing out the fact that you're getting a 30 billion a month fiscal drag coming from the tariffs. And according to Donkey Face Lutnick, I haven't mentioned his name in a while, Donkey Face, that's my nickname for him, because he looks like a donkey face. Donkey Face said it's going to go up to 50 billion a month. Now, of course, when Donkey Face says it, and even when Trump says it, they're presenting it like it's a great thing, like the government's making money, the government is making money. But that's money that's being transferred from firms or indirectly from us, if firms pass along those higher costs, those tariffs. So the government's making money. That's like giving the money to the monopoly game, to the box, right? I'll use the monopoly game. It takes away from your balances, what you have of that blue and yellow and red and pink money. Like, that's just transferring your money to the monopoly box. So unless that's offset, if we're talking 50 billion a month, if that's what it's going to go to, and I totally think that we will see at least 50 billion a month, because right now we're doing 30 billion a month, and the new set of tariffs, I don't think they even hit yet. Like, I'm not seeing it in the Treasury statement. We're still running at about around 400 million a day, which is where we've been running now since the tariffs got going. So I haven't seen any increase with like the second tranche of tariffs yet, the second set, and Trump just extended the China another 90 days. So 50 billion, you're talking 600 billion drain annually. 600 billion drain annually. So yeah, that's not nothing. All right. In a 29 trillion economy, what's that? That's like 2%. That's like 2%. So if we're growing at 3%, you subtract 2% if there's no other offset to that. And now you're growing at around 1% if you're lucky, because, most economists would say there's a multiplier effect in that. It's not just, if you're taking away 600 billion from one group, firms or whatever, that gets passed along, and employees start to feel it. Other firms who are maybe not in the import business start to feel it, because they're dealing with firms that are, and they have, those other firms are losing some profitability. So at the very least, if that's not offset, we're talking about a drop in the GDP growth rate to like 1%. Now, I keep saying I don't have the information yet. You may ask, well, Mike, what do you mean? I mean, I don't know the impact of the big BB, the big beautiful bill. Okay? The tax cuts. Because tax cuts functionally, that's the fiscal equivalent of spending increases. All right? So I don't know yet. I mean, right now, remember, I've always used the analogy like you're flying an airplane. You got to look at your instruments. Your instruments tell you everything. You can't ignore your instruments. You're in a fog. You're in a cloud. You don't have visuals on the ground. You got to rely on your instruments. That's telling you, or you're a navigator, you're a mariner out on the open seas. It looks like, hey, maybe I should go this way, but you can't do, hey, it looks like. You got to rely on your instruments. So, my instruments, those are the fiscal flows. So like I'm flying that plane or I'm sailing that sailboat right now, and I'm telling you, like, yeah, there may be some problems up ahead. But right now, my instruments are telling me, like, stay the course. I don't just willy-nilly, I think I'm going to go short right now. It's not telling me that. Like if I'm flying that plane and it's, I decide I'm going to change my heading because I think I see some clouds, some lightning in the distance or something. But my instruments are telling me it's cool, keep going straight. I'm looking at radar, I'm looking at all this other stuff. You can't do that. I don't do that. Now, a lot of people are not me. A lot of people will speculate in advance. I used to be that way. Look, before I got into this framework of analysis that I use, and I'm talking about, let's go all the way back. Let's go all the way back to my early days, when I was trading on the commodity exchange. And really, I was kind of a halfway chartist and then a halfway kind of seat of my pants. I gave you the story about the early days when I had kind of like inside information, when I was trading off of paper because I had an edge with the brokers, or I knew my friend at the oil company. After that, I kind of had to go out on my own. When those opportunities went away, when those situations went away, I had to go out kind of like on my own. I started on my own. Then I made those connections. I made a lot of money. Then those connections went away. Things changed. And then I kind of like had a rebirth where I had to go back out on my own. And that wasn't so great. I didn't have that edge anymore. I was a halfway chartist and I was a halfway seat of my pants. And if you know anything about me, if you knew me when I was young, I think it maybe still applies to some degree now, but I was very, what's the word? High strung. High strung. So like I would react emotionally. I would see something happen in the pits and I got to buy now or I got to sell. And it was just like the wrong thing to do. Like the market would be going down. And, I'd watch it go down and then I would just like reflexively pull the trigger and go short. That was the bottom. Or the same thing on the upside. I would watch it. Maybe I went home the night before and I looked at my charts and I was like, if it gets down to here or if it breaks this line, you got to buy tomorrow. Tomorrow when you get down there on the exchange, if it breaks this line or whatever. And then it would happen. And I would just sit there and watch it. And then eventually I would jump in. And of course, it would go a couple of ticks against me. I would sell out. Then it would go back in the right direction. I would get back in. Then it would go down. I would sell out. Then it would go back and forth, chopping myself to bits. I don't do that anymore. Not since a long time. It's funny, man, because it's like, I keep telling you guys, like, it's really all behavior. It's really all behavior. I mean, it's that, and it's also, if you have an understanding, like I tell you guys, like, if you go against stupidity, if you go against ignorance, I saw a thing today in Zero Intelligence Hedge, Zero Hedge, I call it Zero Intelligence Hedge, that blog. Big headline, blaring, something to the effect of, the deficit explodes in July, even with the tariffs. explodes. This was a big blaring headline in Zero Intelligence Hedge. And like, I look at the numbers. July had, and remember, I don't call it a deficit. I call it net government transfers. Might be a deficit for the government, but those are transfers going to us, going to the economy. The deficit, I'll use that term, that word in this conversation, but you guys know me. I never use that. And I would recommend that you guys stop using that. It has negative connotations. It's misleading. It puts you in the trap of thinking the same way that everybody else out there thinks, which is wrong. Use my terminology and start to use that with other people. Net government transfers. Government transfers. It's money being transferred to us. Yeah, Mike, but where does it come from? We have to pay it in taxes. No, we can't pay on taxes at all until the government puts dollars in the economy. You can't play the monopoly game until the game distributes the money. Anyway, so there's that headline, right? Explodes. So they use hyperbolic language all the time, right? So I looked it up. 240 billion was the deficit in July. And that came off of a 62 billion surplus in June. The government ran a surplus in June. So I couldn't read this whole article because it was behind a paywall, but I'm pretty sure I know what it was talking about because they were looking at, oh, we had a surplus in June, and now look, we had this big deficit in July. Well, first of all, that 240 billion deficit in July, that was the smallest deficit since January. Okay, when I think the deficit in January was like 185 billion. That's number one. Number two, it would have been like 30 billion higher if it wasn't for the tariffs. The tariffs reduced it by 30 billion. So it would have been like more like a 270 billion transfer deficit. But no, the headline was the deficit explodes in July. This is why I tell you guys, like, number one, you can't take any of this stuff you read or you hear on CNBC or Fox as any kind of information whatsoever. And however, if you're gonna watch those TV shows, CNBC, Fox Business, whatever, if you're gonna read these crazy blogs or commentaries, like Zero Intelligence Hedge, you got to look at that as a contrarian thing. You got to look at that like 99.9% of the time. Unless they're reporting actual events, just like a journalistic report, and not framing it in a certain way. Unless it's pure data that they're reporting and not given, a slant or some color on it. You have to look at that in a contrarian way. Even if they turn out to be right every once in a while, if you merely look at that with a contrarian attitude, perspective, like, oh, there's a headline, it exploded, means nothing, I got to go against that fear, that concern, whatever it is. If you do that, I pretty much guarantee you that over a period of time, you'll be way, way up in your, pursuit to acquire wealth, in your activities in the market. That's really all you have to do. Anyway, that's pretty much all I could think of for today. Thinking about fishing. All right, please like and subscribe. Thank you very much for watching my video. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Bye.